Welcome to the deep dive. Ever looked at a company's financial report and seen a line like investment in unconsolidated entities and thought, okay, what's really behind that single number? Well, today we're kind of cracking open that black box. We'll show you how a seemingly simple investment can reveal some pretty intricate relationships, maybe hidden risks, and a surprisingly complex accounting judgments. It really turns that one line item into, well, almost a detective story for understanding a company's true financial health. Our deep dive today is all about equity method investments in joint ventures, and we're pulling directly from some really comprehensive financial accounting sources, specifically an updated September 2023 chapter covering these topics. This material draws heavily from key accounting standards, often referred to as ASC, the Accounting Standards Codification, and also various SEC guidance.
Right. So our mission today, it's basically to hack through all that technical jargon. We want to help you really grasp the core principles of these investments, why these distinctions actually matter, and what they can tell you about a company's financial health and maybe its less obvious partnerships. The goal really is to give you that shortcut to being truly well-informed about this crucial but, yeah, often overlooked aspect of financial reporting.
Okay, so let's unpack this financial mystery then. We should probably start with the foundational concept. What is an equity method investment exactly? At its heart, it's about situations where one company, the investor, has enough sway, enough influence to significantly affect another company's operating and financial policies. It's not outright control, mind you, but it's definitely more than just being a passive shareholder. And while there are exceptions, you'll often see this when an investor owns, say, somewhere between 20% and 50% of the common stock of another business.
Yeah, and what's really key here is that significant influence isn't about absolute control, like you said. Think of it more as having a strong voice, maybe a seat on the board or the ability to sway major strategic decisions, even if you can't dictate every single move. The main rule book for understanding all this is something called ASC 323 that governs investments, equity method, and joint ventures. It's pretty much the foundational standard for this whole area.
Something subtle but quite critical that the sources highlight is this. Even when an investor does have that significant influence, they can sometimes choose a different path for accounting. It's called the fair value option.
Yeah.
Now, why would they do that? Especially if they have so much influence. And what does that choice really tell you?
That's a really interesting point.
It's not like a free pass from transparency. Our sources are clear. The specific disclosures under ASC 323 are still absolutely required. But for you, the sort of astute observer, it might signal how management sees the volatility of that investment, maybe, or perhaps how they want to present its value to the market. It's a strategic choice, not purely accounting.
Exactly. It adds another layer. And this whole concept of significant influence, it also directly applies to joint ventures. Those distinct entities often formed when two or more companies pool resources for a specific project. And actually, there was a very recent update on this just last August, ASU 2023-05. It specifically focused on how companies should account for the formation of these joint ventures. It just shows how dynamic this area of accounting really is. Things keep evolving.
Okay, so we've defined what these investments are, broadly speaking. But the big question for anyone looking at financial reports is, how do they actually show up? On a company's financial statement. Let's start with the balance sheet. That's the snapshot, right? A company's financial health at one specific moment.
Right. Think of it this way. On the balance sheet, these investments usually appear as just one single number, often called something straightforward like investment at equity. Now, this number isn't just what the company initially paid. It's what we call the carrying value. Essentially, it represents the investor's slice of the other company's overall net worth, their total assets, minus their total debts, basically. But here's a crucial detail and something to watch out for. If your share of their losses is actually more than what you initially invested, well, that extra loss doesn't just disappear. It gets recorded as a liability on your balance sheet, like a future obligation or debt you've effectively taken on because of their struggles. You might see these described with phrases like accumulated losses of unconsolidated companies and excess of investment. It's a red flag, potentially.
That is a crucial detail, especially recording losses as a liability. It actually brings to mind a specific question from our source material. It's posed as question FSP 10-1. It asks, is a reporting entity permitted to separately present its share of each asset and liability of its investee individually? So can they break down that single line item? Show the detail.
That's an excellent question. And the answer from the PwC response in our sources generally no. This kind of detailed presentation, sometimes called proportionate consolidation or expanded equity, is typically not allowed. It's really designed to prevent companies from looking, well, bigger than they are by blending the investee's individual assets and liabilities with their own balance sheet. There are very specific, very limited exceptions, maybe for certain unincorporated entities or perhaps in niche industries like mining or construction. But for most companies, it's that single line item. It's a key principle. If you don't control, you don't consolidate line by line. Simple as that, usually.
Okay, so the balance sheet gives us that snapshot, that single line reflecting the carrying value. But what about performance, the day-to-day? How do these shared profits and losses actually flow through when we look at the income statement? The report that tells us how much money a company is making over time.
Right, the income statement. Well, similar to the balance sheet, the investor's share of the investee's earnings or losses is generally presented as a single amount there too. You'll often see it labeled something like equity in net earnings of affiliate, or maybe share of net earnings of equity method investee, something along those lines. Let's use a quick example from the source material, make it concrete. Imagine FSP Corp owns 40% of Company A. If Company A's net income for the period was, say, $96,000 after taxes, FSP Corp's share would be $39,000. That's just 40% of the $96,000. Makes sense. This $39,000 then gets added to FSP Corp's own income, contributing to FSP Corp's total net income, which in the example was $135,000. And here's a key point from the SEC staff guidance. This share of earnings typically shows up right within the company's operating income. It's not usually tucked away, somewhat obscure in other income. It's right there, signaling that this investment is considered part of the core business activity. That's a pretty significant indicator for investors, actually.
Okay, so we've covered the basics, the balance sheet, the income statement. But I'm guessing the real world of accounting throws a lot of curveballs, right? What are some of those unexpected scenarios, maybe those gotchas, that can make accounting for these investments, well, far more complicated than it first appears?
Oh, absolutely. It's really straightforward. Beyond just the basic profit sharing, think about this. What if the investor and the investee have other financial dealings? Like imagine the investor is also a key supplier to the investee, or maybe they're charging the investee royalties for using intellectual property. These are what the guidance calls other relationships, and the money changing hands, those royalties, technical fees, whatever, they aren't just separate transactions floating in space. They can significantly alter the true economic relationship and the overall return on that investment. You know, a sharp analyst would really dig into the disclosures around these because sometimes they can be used to, let's say, manage reported earnings or shift value in ways that aren't immediately obvious from just looking at the equity income line.
That's a fascinating layer, adds a lot of potential complexity. Now, what about when things change more fundamentally? Like, what if the investor decides to sell off a big chunk of the investment, or maybe even the whole thing? Does it just vanish from the books, or how does that shift in influence or ownership hit the financials?
Good question. When an investor sells part or all of an equity method investment, any gain or loss from that sale is typically presented as other income on the income statement, not operating income usually. And what's interesting is that these gains or losses are generally shown gross of tax, meaning before factoring in taxes. So the headline number can look quite large. Another critical scenario is when an investment just no longer qualifies for the equity method. Maybe you sell enough shares that you dip below that significant influence threshold. In those cases, any investment you still hold typically gets reclassified. It's accounted for differently going forward, maybe just as a standard marketable security measured at fair value. And here's a subtle point. Certain accumulated other comprehensive income items might get affected. That's a bit technical.
Yeah, what does that mean exactly?
It basically means some gains or losses that previously bypassed the income statement, things like foreign currency translation adjustments, might suddenly have to be recognized in net income when you lose that equity method status. So a potential hit or boost to earnings there.
Okay. And impairment. That always sounds like bad news in accounting. How does that work with these investments? When does a company have to basically admit, okay, this investment has gone sour?
You're right. Impairment is never good news. For equity method investments, if there's an other than temporary impairment, meaning its fair value has dropped significantly below its carrying value and it's not expected to bounce back soon, well, those impairment charges are recognized directly as part of the investor's share of earnings or losses from that affiliate. So it's not just an asset write-down hidden away somewhere on the balance sheet. It directly reduces the profitability reported from that specific investment line on the income statement. It really signals a tangible hit to the company's bottom line from that venture.
It's really clear these rules aren't static. They keep changing.
I'm seeing a reference here in our sources to some really new guidance on something called investments in tax credit entities. What's the latest development there, and why is it important for how we interpret these types of investments?
Yes, that's a very recent and pretty significant development. Back in March 2023, new guidance, ASU 2023-02, was issued. What it does is it allows companies to elect to use something called the proportional amortization method for certain qualifying tax credit investments. Think things like investments in affordable housing projects or maybe renewable energy initiatives. This new method basically offers an alternative and potentially simpler way to account for these specific, often quite complex investments where the primary return comes from tax credits rather than operating income. It lets companies sort of spread out the recognition of the investment cost against the tax credits over time. It's rolling out very soon. It becomes effective for public companies in December 2023, and then for everyone else in December 2024. So as you look at financials next year, you might start seeing companies adopt this new approach. It could provide a clearer picture for these specific kinds of investments.
Okay, so putting this all together, what does this really mean for you as someone looking at a company's financial statements? It sounds like it really boils down to the absolutely critical importance of the disclosures, right? That single line item on the balance sheet or income statement is just, well, the tip of the iceberg.
Precisely. Couldn't have said it better. To truly understand what's going on with these investments, you absolutely have to dig into the notes to the financial statements. ASC 323 actually mandates pretty extensive disclosures. Companies have to tell you things like the name of each significant investee, their percentage of ownership, the accounting policies they're using, also a qualitative description of any goodwill recognized, that's the premium paid over the fair value of the investee's net assets at acquisition. And if it's available, the market value of the investment. Crucially, they also have to provide summarized financial information about the investee. We're talking key numbers like their assets, liabilities, and results of operations. And it's worth noting, the SEC rules, specifically SX, require these summary financial details if the investment is individually significant, usually meaning it represents over 20% of the investor's assets or income. Or even if they aren't individually significant, if they are significant when you add them all up together, if the total hits over 10%. These disclosures are really your window into the health and performance of that partner company.
And speaking of the latest updates and digging into details, joint ventures saw some really significant changes quite recently, didn't they? Especially around those disclosures.
They absolutely did. Our sources highlight a specific new section added in September 2023 titled Joint Venture Entity Disclosures. This came directly from that ASU 2023-05 we mentioned, issued last August. This new guidance specifically focuses on providing more transparent information. The goal is to help users like you understand the nature and the financial effects of forming these joint ventures. So key disclosures now include things like the date the JV was formed, its stated purpose, what its fair value was estimated to be at formation, and also detailed descriptions of the specific assets contributed and liabilities assumed when it was set up. And here's an important detail. Companies now also have to disclose any provisional amounts if the initial accounting for the JV formation isn't quite complete yet, and crucially, they need to explain why it's incomplete. It's all part of this bigger push for more transparency into these often complex shared business arrangements.
Wow, what a deep dive this has really been. It truly shows that what might appear as just a single, seemingly simple line on a financial statement, equity and earnings of unconsolidated entities or something similar, it's actually underpinned by the surprisingly detailed and constantly evolving set of accounting rules. Rules that require some really complex judgments about influence, very nuanced calculations, and as we've seen, meticulous disclosure to ensure transparency. It's almost like a financial detective story, isn't it? You see that one number, but then you really have to peel back the layers, dig into those notes to understand the full picture.
Indeed. It really highlights the complexity. So maybe next time you're reviewing a financial report and you encounter a line item like equity method investments or earnings from affiliates, consider not just the number itself, but that whole invisible framework behind it. The framework of significant influence, the thresholds that trigger specific accounting treatments, and the ongoing efforts by the standard setters to try and provide better transparency. And maybe this raises an important question for you to ponder. What other seemingly straightforward figures lurking in those financial reports might hide equally fascinating and complex accounting stories just waiting for you to discover?